Futures point to a flat open on continuing unease over the European economy. Spain has seen many of its banks downgraded in recent days. JP Morgan CEO Jamie Dimon testifies before Congress about the multi-billion-dollar losses the bank took on trades last month and risk management. I'm Taylor Schrantz, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Jill Malandrino with The Street, and together we bring you the morning call. Scott, it's really shaping up to be an interesting week. We had a big down day on Monday, nice day yesterday led by the techs. We have quad witching coming up on Friday and elections on June 17th in Greece. It's been a really busy week to say the least.
It seems like there's no shortage of bad news out there, but when I look technically overall at the market, we're actually holding in pretty well. You've seen a lot of choppy action, you've seen a lot of traders pulling their hair out looking for follow-through, but that typically happens before we get some type of range resolution. And like you said, this week's been interesting where, you know, we've been holding higher, we've been holding above 1310-ish on the S&P, and right now we're knocking on the door at that resistance. The question is, can we resolve to the upside? And does the news get a little bit better this weekend, like Greece actually staying in?
Because today and even over the next few sessions, it feels like it could be a little bit pivotal here where we might get some commitment either way.
Yeah, like if you look at the chart, let's go to the chart of the S&P. You will see that, you know, obviously that we've had a lot of macro patterns here controlling the trade. First macro pattern was this head and shoulders top that gave us a nice move down to the lower level here, about 11% off the highs. And then we had this outside reversal way back when. It feels like it was a decade ago. It was only like 2 weeks. Then we took back the 200-day. And now there's this very interesting pattern that we've been trying to be a little forward-looking. It's the inverted head and shoulders pattern. We have the left shoulder, the head, the right shoulder. And right now we've been very choppy within this right shoulder, but this is what you have to look at that's important. We're holding above 1306 to 1310, holding higher, top third of this range. Okay, we're also getting a defined downtrend that we could trade against also. So if you were short and we break above this per se 1330 with some volume and with some, I don't know, I guess what the market could be perceived as good news, we could get a move to this 1360, you know, and if you're looking to lean on the shorts, I would just wait. If this starts giving way 1306, then perhaps we get a retest of those. So right now, guys are watching which way we're going to resolve, and I think wait for it to start or to get in motion, and then jump on board instead of thinking you have all the answers.
Well, luckily we'll get the volume and volatility back as we go into quad witching on Friday, so we might get some opportunity there because God knows we definitely need the volume in this market. Moving on to the sector spotlight, we're going to look at the news coming out of WWDC as it relates to Apple and as it relates to the derivative plays off of it. But first, let's take a look at Apple, which we talk about in every morning call. It wouldn't be that without it, but we saw some news coming out in terms of voice integration and other mapping services with the new iOS upgrade.
Yeah, well, the conference came and went, and they did what they typically do. They sell the news. And it was actually a really good short because it pushed through that 580, came back below, went down like $8, $9. And then even yesterday, tactically, it opened up, and you could have shorted it. It traded through the prior day low and came back above. So tactically, you can make money both long and short. On a macro level, I do think longer term it will be higher. Question is, can it start to get in motion now? If you look here at the chart, you will see, you know, last time it tried to break through a pivotal point was 560, and the market saved it. This was the day of the conference. It didn't have enough strength, didn't do iPhone 5, it didn't talk about ITV as much, so it reversed. But look what happened yesterday. It also held in firm. Broke below 570, went as low as 566, came back up. So I would say right now, if you're long it, be long versus yesterday's low of 566. If it starts trading back above 580, it'll negate this short-term sell signal or short-term weakness or technical damage, and then that'll also give us clues that finally the market could be bought on strength instead of just on the dip. So if Apple starts getting above 580 and can continue, I think that could lend some confidence to buying the S&P or the Qs or the overall market higher.
Moving along to Garmin, we haven't spoken about this name in a while, but it caught a nice big yesterday after being down 9% on Monday following Apple's announcement that it's beefing up its mapping services in the next iOS upgrade.
Yeah, this one has not been talked about because it's been technically poor, bad stock, so to speak. You know, you look at the chart here, ever since it gapped up on this day, you know, or tried to break out and failed, it was a sell signal, and that's what you look for. Look, it should never have reversed here in these 2 days trying to get some momentum into new highs. So that was a sell signal, and it's been coming down ever since. It's below the 200-day, the moving averages. I know yesterday, you know, you saw some strength, but, you know, at this point, I don't think it's very compelling. It could continue back to 40, 50, or 42, but I don't think this is investment quality.
Moving along to Dell, this was interesting. Yesterday, after the close, it announced it's going to start paying a dividend of 8 cents per quarter. This is interesting because we've seen a lot of these large cap cash-rich tech names start to really reward their shareholders in this way. Prior to that, Dell, HP, a little bit of under pressure because Apple, not only are they dominant in the mobile space, they're also looking to gain some market share in the PC computer space as well.
These mega cap tech names could only be bought in extreme weakness because you try and buy them higher, it just doesn't work. And they're giving a dividend because they can't find any growth. The companies are mature, they've tried to reinvent themselves, they haven't been able to do it. I guess if you look at the pattern yesterday, technically short term, you had an outside reversal. So if you weren't caught in this mess, in this bad earnings report, you looked yesterday, just technically what it did is it did a red dog reversal. You said your system loves that when I say that. Well, here you go. It made a new low, came back above, so that right there is a tactical long. Just could be a day, could lead to more than that. So anyone who just played it for that didn't know they were going to come out with a dividend, and they got rewarded. But at this point, I think there's going to be a wall of resistance. I just think it's a trade. I do not think you need to be an investor in Dell, but if you want to be long versus this 1168, and at least you have your stop well defined.
Right, and also get a little bit of a dividend now to sort of pay you for hanging out. But like you said, there are other opportunities in the market. Moving along to Oracle, the database giant, and it's always looking over its shoulder because when you are the giant, there's always little competitors behind you, such as Citrix and VMW. And then you also have cloud computing, which is becoming huge competition in that space. And again, with Apple, the iCloud.
The stock also, it went from being institutionally supported to finally it started to do some missteps. Why not? They have a huge European business. They have a huge business with the public sector, which is also constricting somewhat. So it's been more of a short versus a long, but now trading it versus major support, I guess, is a decent entry. If you look here, you will see, this 25 is huge for Oracle. It's come in, it's now held it 3 different times. So if you are long on a macro level, I would say do not stay in this if it breaks 25. This is that low. It just had to move off the low. It's trying to flag here. Some traders might look to get long if it starts breaking above 27.15, but then if it does get going, here are all these moving averages, and this is just going to be another wall of resistance. So I don't see anything so compelling here also, but what I do see is if this 25 can hold, because it's you never heard of a quad low. This is right now a triple bottom, which is rare also. I would get out of the way because the next level underneath this is around 20 and change.
And let's wrap it up with a semi-name, Texas Instruments. They had their mid-quarter update. They guided within the mid-range. Analysts weren't too happy about that because they expected a little bit more from it. And I also think the stock is a little bit expensive at this point too. What's the charts telling us?
I agree. I think if you're going to go with a semi-name like this, just go with Intel. No need to go with Texan. If you look at the chart of Texan, you'll see, yeah, it's a little bit off the lows, but it's also below the moving averages. It's not showing any relative strength. Last trade here is when it broke this upper level, okay, to get out of the way. So if you did get out of the way, I guess as a trade, there's a small downtrend here, right? So here's your low. It held higher. If it starts breaking above this 29, your next level is around 30. I don't hear my traders talking about it because there's really not that much action there.
All right, guys, we're going to jump into a quick commercial, and when we come back, we dive into the trenches.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back to the Morning Call. Scott and I dive into the trenches with the energy names and its impact on travel names. So Scott, let's kick it off and take a look at the ETF, the USO. Yeah,
oil has been just battered and bruised, and thank goodness. Hopefully one day it'll relate to some savings by the consumer. Yesterday we started tweeting about, okay, oil just went from 100 down to the low 80s, and gasoline is still not falling, or they're not lowering prices, so it's not even giving the consumers the tailwind, which it could if gasoline fell. So I think regulators want to get Jamie Dimon on the stand. Maybe these regulators should start going to the gas stations and have them lower their damn prices because they're gouging. But anyway, let's talk the stock market with it. Oil right here, is coming off the lows. From 40 in the USO all the way down to 31. It's always hard to short things near the bottom. So let's see if it could rally. You had this bearish close that was trapped a bit yesterday. So if you want to be long a little oil, versus the price, I think you could be long oil versus 80, 81. If you want to be long the USO, be long versus this 30.67. If oil were to get going, you have a small pivot just like the market, just like this lower range, it would have to start clearing this 32. So above 32 USO, you have a rally back to about maybe 33 or to fill this gap up to 34. But again, this is the trade that guys are looking for. It's not sexy or huge, but you break the slower range, you have a move up, and the question is this rally a rally to be sold or held? And at this point, it's the rally to be sold, in my opinion.
Speaking of prices that make absolutely no sense, look at take a look at the airlines with Delta and United Continental. I travel to Chicago once, twice a month to work from the exchanges there, and it makes zero rhyme or reason how when oil's over 100, my trip in May cost me $250. My trip in June, where it's $20 cheaper for oil, it's costing me $380. So there's zero rhyme or reason. The airlines are under pressure because of European pressure, and the prices keep going up. So, Scott, I mean, what are the stocks telling us with Delta and United?
I just don't typically invest in airline stocks.
Right.
You know, everyone says, oh, oil goes down, it's going to be great for the airlines. And like you said, they're not passing the savings. Maybe it could be good for them because their margins are getting better because they're able to charge higher with a little middle there for them. But the chart right now of like Delta, I look at it, it's pretty gross. So you just look at it right here and you'll see, you know, it tried to break out and it couldn't. So anytime you get a false breakout, which I try and say 100 different times because it usually leads to weakness, you had momentum come in, and it failed. You never want to see that happen, especially as a momentum trader, let alone an investor. So at this particular point, you know, it did bounce back and try and take half of this, you know, this wide range bar. But I see a bear flag forming here, and if this starts to break below this $10 level, the next move is going to be down to this 200-day at 924.
And United, relatively similar chart.
Let's take a quick look. UAL.
That's what they get for gouging prices. Crappy stocks.
And I'll tell you, I don't know why Continental friggin' merged with United, because I trade out of, or I fly out of Newark, and in the old planes. I used to like Continental. Now they have the workers that hated working at United, now working for Continental. They're even more pissed off. But anyway, you look at the chart here of UAL, and this is a pretty big uptrend that it's been following. I would say some guys are licking their chops that if it starts breaking below this 22, you can get a nice little short here. It just came from 25 down here, so it might stay in this area. If it can't get back above 23, I think you get more of a short through 22 than trying to buy support here.
Moving along to Priceline, we've been speaking about this one for a couple months right now. Remember, we came on April 24th. Why remember this day is beyond me. But anyway, we came on April 24th. It was trading in the 630, 640-ish range. Benchmark came out, taking their price target to 750, reiterating their outperform. This stock has returned 400% since pre-subprime levels, 16.5% in just the last month alone. Is it worth it anymore? I mean, can this continue?
I think a lot of hedge funds have been put out of business because, I mean, just trying to short Priceline. I think ever since Shatner came on with those commercials, you know, he made money. But anyway, at this point, it's still in the game. It's still considered one of the stronger stocks. And if you look at the chart right now, last trade was when it broke above this small descending channel. I personally don't trust it. I don't like their business model. But technically, you can't argue with it because it does blow people out of their short positions. And right now, here's a big level. As long as it holds above 630, and I think Sperling's been trading this very well, I think you can get an additional move. And resistance right now stands around 660. So above 660, you're going to see shorts get squeezed, and you might see, you know, some continuation to the upside, which, you know, put this in the category not of Apple, but usually when the high beta names go, Apple goes, Priceline squeezes, and you could have them, you know, the level twos near each other.
Same thing with Expedia. I'm sorry, I made a mistake on that. They returned 16.5% in the last month alone. It's been pretty interesting how this one has just continued to be on an uptrend, whereas Priceline's been in a little bit of under pressure. But I mean, can this continue on its uptrend? Well,
Expedia is a good example of, you know, if you have a thesis, get away from it if the market doesn't confirm it. And everyone said after earnings, why is it up? They can't continue. Almost the same thing they said about Priceline a few years back. But we talk about strategies, and tactically, it gapped up and it never filled its gap. That shows you power. That shows you potential continuation. If you look at the chart here of Expedia, you will see we've talked about it off the charts so many times. Look at the size of this gap. It didn't even come in close to filling it. So the shorts are trapped. People wanting cheaper prices couldn't get it. So it turned into a really nice trade above this area, above 41.88. I think we listed it like 3 times, and now it's at new highs. And at this point, I never want to see someone initiate a new position into new highs. But just because it's at new highs doesn't mean you should be shorting it either.
Now let's wrap it up with HOT. Here's something else that's really interesting. Where is it? Business travelers, its revenue has risen 9.3% year over year, 7.2% for leisure travelers, even though airlines and oil have gone up. or oil has come down and airline prices have gone up. So it's amazing to me that, you know, revenue can just continue to grow with something like an HOT.
Well, let's take a look at the chart. The chart right now, it's a middle ground. It's trying to hold the 200-day. It rallied back up with the market. It's still controlled by this somewhat downtrend that's been intact like most scenarios. I would say at this point, be long versus 48, and it could get a little bit more upside if it could start getting above this downtrend, but this to me doesn't look like a compelling spot either.
All right, let's move along to quick hits or some quick cash. We're going to kick it off with JP Morgan. We have Diamond on the stand in front, well, actually sitting in front of Congress today, talking about risk management. And I know a lot of guys are looking for that buying opportunity, almost like reinforce. Yeah, we do get risk management. So
yes, and this stock's very important. Obviously, him up there, they're going to try and grill him. They're going to try and batter and bruise him. And I think that he's taken the hardest punches already. So if he comes out today looking like he normally does, composed, and maybe he's going to probably say he's sorry and he messed up, which they did. So we'll see whether or not that could rally the market. Because if you remember, when they came out and announced a $4.2 billion loss, that was the day they bought the market and they bought that stock. So today, maybe everyone's scared to be in JP Morgan because he's going to Congress. So they like to make everyone feel stupid. It could potentially move the market higher. So look here, and you will see that this does also have a bit of an inverted head and shoulders pattern. Here's your left shoulder, here's the head, here's the right shoulder. If you started getting out with this technical damage, look what happened on earnings day. This was earnings day when the market rejected earnings right there. That was your technical sell signal way before they announced this big loss coming. So if you did get out of the way, it's trying to build a lower pivot here. Guys short term are probably trading it long versus this 32.50, and it's made a lot more sense buying the weakness. So the question is, can you finally buy as it goes higher, which we have not been able to do since the market's corrected? So we'll watch here. Gets above this, just say 34.5. You could see it move back to about 36, and that would be very helpful for people who are trying to make money long this market. Moving
along to Dunkin' Donuts, and do I wish I had a coffee right now, but looking at this name and also
not Dunkin', but anyway.
Looking at Starbucks, it seems like both these names have cooled off a bit.
No, I think Dunkin' actually looks awesome. I've said it so many different times that this is an IRA stock. You have a little mix of Starbucks, a little mix of McDonald's. You have a new issue. It's been handled very well. You look at the chart here at Dunkin', and this stock is close to breaking out again. Last time we really talked about it was right here when it had this cup and handle pattern. This was a time to get involved right around 29.50, and now it looks like it's ready to make highs. I do think within the next year to 2 years, this stock should be north of 40, and I think it's a buy and hold.
All right, moving along to CRM. This is one of those names where we're always looking at the revenue that they draw in is really, really good, but their cost seems to increase at the same time too. So this is one of those names where you always want to look at margin and how well it's expanding or not for that matter.
Yeah, this one I would say try and avoid. If we need to be in one of these type names, I would be in VMW versus CRM. Right. The multiple's high. A lot of people hate them. They're a bad headline away from another correction. If you look real quickly, there's a small support area to watch. Here it is. I would say if you're long it, be long versus this area. This area right here is 126.32, but this stock to me doesn't look compelling, and it's more dangerous than profit potential. Moving along to AGU, we've been talking about this one a lot this week. One of my AGs, my 2012 pick, Mosaic being my favorite within the space. AGU took up their dividend 120% last week. They are firing on all metrics right now, and they had a great investor day where they're guiding to the higher end of guidance. Well, I want to show you guys this chart because this is why you get excited when stocks try and break through key levels. And right now the key levels are these lower pivots across the board. And with AGU, yesterday a lot of guys, I heard them chirping about it because it broke through a level and it closed strong. And that's all you can ask for tactically. So if you look here at the chart, this is a nice lower level. This almost looks a little bit like some of the other charts I showed you where you had somewhat of an inverted head and shoulders pattern where here's the left shoulder, here's the head right there, and then it started to hold higher. And look what can happen. You could break through this resistance, and it broke through this resistance. People were buying it at just say 80.49, and it closed strong. So that's why we identify these patterns, because if it breaks through an area, shorts get squeezed, and you can get a healthy move. So if you're short any of these patterns we're talking about at this neckline or at this downtrend, be careful for a move like this. And if you're looking to a tradable pattern, this one paid off yesterday. This and Monsanto seem to have the best relative strength within the ag group with the little CF. All right, and let's wrap it up with some more key levels with eBay. eBay, just off the top of my head, I know this has been acting better. The market hasn't let it break out yet. It was part of that, gap up after earnings. It filled it a little bit. Even Amazon did as well. It, to me, looks like one of the chosen ones. It's a bit stronger. It's hovering near the highs here. This is this should be on every trader's radar, because if this thing could finally get above 41.72, you're going to see some type of clean move, and that'll also give some conviction that you could buy things higher. But here was that earnings gap. It struggled to hold it. It did hold the majority of it. It's above all the moving averages. This is a chart that I like to look at, and this is more investment quality than a lot of the other names that we actually saw earlier today. All right, and speaking of the charts, don't forget, Scott, at the end of the day, every day on Options, Profits, Real Money, and T3Live.com as the team wraps up the trading day for us.
Bye.